Welcome to Module 26 on Term Structure of Interest Rate Part 1. In this particular context, we are going to delve into the concept of interest rates. Now, what are interest rates? Interest rates are mainly the opportunity cost of holding bonds, whether it is from the investor's perspective or the rate of return from the lender's perspective. And basically, in a loanable fund market, when the market is at equilibrium, then these two returns equate each other and thereby the level of loanable funds are determined. In the context of the term structure of interest rates, it is basically dealing with the maturity period, and so different interest rates prevail under different maturity loans. This also takes care of most of the theories which explain the term structure on the underlying assumption that the supply and the demand for the loanable funds equilibrate each other. This also takes care of different interest rates that can adjust with different levels of inflation, and thereafter the aggregate saving and the aggregate investments get adjusted. And this proposes two main theories to enrich this explanation and explain the different interest rates over different maturity terms. Now we move on to the term structure and how is it related to different interest rates at different spot rates. For this, we consider a graphical representation of a sample term structure. So we observe that the term to maturity, which is measured in years, is plotted on the x-axis and the spot rate is plotted on the y-axis. In this particular trend, we call this curve as a yield curve, so that the curve is plotted from the interest rate of 8% and it keeps on rise till it reaches the 10%. So with the help of a numerical example, we can show that if the rate of interest of R1 is 8%, R2 is 9%, R3 is 9.5%, and accordingly we get different spot rates against the terms of maturity. So this trend is eventually called the yield curve, which will provide different levels of maturity at different levels of interest rates. This also calls to be saying to an important question in this regard, that how can we conceptualize interest rate structure? So by conceptualization we mean that the term structure of interest rate refers to different interest rate that exist over different term to maturity loans, whereby we call the maturity loans as at the period of the peak or when the investors and the borrowers' interests are satisfied. The term structure also refers to different time frames where these loans can be matured. This boils down to the definitional part of certain important terminologies in the context of the term structure of interest rate. Among them, the first one is called the spot rate. So here the spot rate is defined in an n period. Basically, n is a finite number which can be 1 to 20 or 30, but we consider a generalized definition of n period. So the n period spot rate of interest denoted by Rn is the current interest rate fixed today for a loan, and that is to be repaid in the n periods. So we observe that any kind of loan which is raised in the current year and it is to be repaid in the nth year, then the spot rate will be the rate that is prevailing in the nth year. That is what the spot rate is considered. So all the spot rates are expressed in form of an effective interest rate per year, because the spot rates keep on changing depending on different interest rates at different time periods. This boils down to the saying that spot rates are only determined from the prices of zero coupon bonds, which means where the coupon does not give any initial rate of return, but once it is invested and it is transacted at the current rate of interest, then only the spot rate can be done or can be evaluated. And it is also considered of discounting the cash flows that occur in a single time period. So basically, when we discount the cash flows over a period of time, and that is what we mean by the spot rate as mentioned here. This also boils down to the saying that whenever we are discussing on the yield at maturity, or getting the entire investment at the time of maturity of the loan, here the average rate is being used, and that is a discounting rate over a zero level of coupon bond. So basically the spot rate has three main features. It is depending upon the interest rate along different time periods. It is based on the transaction of maturity of a zero coupon bond, and also it is leading to the yield that is derived at the time of maturity. This boils down to another important rate on which the transaction takes place, which is the forward rate. The forward rate is a one-period forward rate, which is denoted by Fn, is the interest rate which is fixed for one period to be repaid at some future time period. So that means money which is borrowed in the period n-1 is to be repaid in the period n, and that is how the forward rate comes in. That means if we consider money that is borrowed in the year 2022, that was basically borrowed in the year 2021, and it will be repaid in this current year. So in this particular forward rate, we can give an example of F2 taking up a very high percentage of 10%, which is a rate agreed upon today when the loan is made and repaid in the following year. So forward rates are the effective interest rate per year, because at the time of the transaction, the borrower and the lender engage into an agreement where the rate of interest is being determined. So this practically gives an example when we are investing $1,000 in a 2-year zero coupon bond where the rate of interest is 9%, and with the compounded rate we get $1188.10 in 2 years. So this is basically equivalent to the investment of 8%, that gives $1080 in 1 year, and then investing in the second year. So we solve for x and keep on doing that, and we estimate the forward rate. So forward rates are determined on different interest rates at different levels of principal amount that is being done. This basically gives us a kind of a formula where the equation becomes useful, because in determining the forward rate over a period of time. So that comes up as 1 plus Fn, which is given by 1 plus Rn whole to the power n, because that is being compounded for the current year, divided by compounded for the year n-1. So here we observe that Fn is 1 period, and we can calculate F2 given the R1, R2. We can calculate F3 given R3. So this is a continuous process, or an iterative process, which will be continued to get the forward rate against the spot rates. So this basically gives us to a very important question, which says definition of the spot rate and the forward rate. So we observe that the current spot rate is denoted by the current interest rate, which is fixed today for a loan that is to be repaid in the n periods, and 1 period forward rate is basically a 1 period lag. That means any kind of loan which is raised in the last year, and that's need to be repaid in the current year. So here n is basically a 1 period lag of the previous year in the current year, and that is how the forward rate can be done. This basically boils down to another important t period forward rate, which is denoted by n minus t Fn. So for example, when we consider a formula of n period forward rate or t period forward rate, we find out that n minus t is mentioning the time period where the loan will be raised, and n with the suffix of f is denoting when it will be repaid. So if we write 2f5, which means 3 period forward rate for a period of 5 borrowed in the period 2. So the earlier 2 which placed before f is basically when the loan is being raised, that is in the second year, and it will be repaid within the 5th year, that is, it total is a maturity of 5 period loan, and that is how the forward rate will come in. So in the same manner, the forward rates can be determined when the data is presented based on the above formula. So this gives rise to many other examples of the future rates and the spot rates, but also we can have a spot rate at a future date. That means current spot rates are observable today and be contracted today. That means whenever we are engaging any kind of dealing of foreign exchange or purchase and sale of gold asset, then we go for the current spot rate, which are observable today and can be contracted today also. But when we discuss on the future spot rate, it will be the rate for a loan obtained in the future and repaid in the later period. That means it will be obtained at a future rate. For example, future spot rates will be based on expected level of inflation. For example, the future spot rate for year 2022 can be the loan which can be raised in the year 2023, with the expected inflation rate of that particular year, and it can be repaid in some later period. That is how the future spot rate comes in. So future spot rate is distinct from ordinary spot rate in the sense that the future spot rate can be realized in the future time period, but ordinary spot rate is actually realized in the current time period, and that is how the definitions differ. This also basically comes to know that we do not currently know what will happen to future spot rate of interest. However, if we understand the theories of the term structure, we can make some predictions or expectations about the future spot rates, because these are highly unpredictable and these are highly random factors. So it is impossible to have any kind of preconceived notion regarding the trends of the future spot rates. So an expectation is being made, and this expectation is not made ordinarily but based on certain theories of the interest rate term structure. So this basically says that the current expectation of the future spot rate is follows as expectation of n minus t Rn. That means you have just now seen that n minus t is the year when the loan is being raised, and n is the year when the loan will be repaid. However, an e is imposed before it, that is expectation, because it is based on the probability, because it is based on the probability distribution when the loan will be realized. So expected future rate will be repaid in n and will be borrowed in the period n minus t, and this realization will be done on the basis of an expectation or on the basis of a probability distribution. This boils down to future spot rates with a real life example. Like for example, you are considering locking in your mortgage rate for 1 year or for 5 years. You would use the longer term if you thought interest rate would be much higher in 1 year. That means there is an expectation that in the future period the cost of borrowing may fall, so it is more rational to go for a 5-year mortgage. If you expect future spot rates in 1 year to be much higher, you will choose the longer term mortgage right now, and that is for your personal life also. That means we find out that if the cost of borrowing is on the fall, then definitely we will take a longer period loan where the future spot rate will be determined. The second example of a financial manager, where you must decide whether your firm should borrow long term or short term. This is a very important decision of a financial analyst, whether the company will engage in a short term loan or a long term loan. So if we want to prefer to borrow short term because these rates are currently lower, however you are concerned about the rates you will face when the loan will be repaid. That means currently the rates may be lower, but in future the rates may rise. So there is a level of uncertainty about the future rise in the price. So you are concerned about the future spot rates at the time your refinance or expectations will affect the current decision and to finance the long and short term. That means the crux of the story is this, that whenever we are deciding on the interest rate, it is always better to incorporate expectation in the model, because expectation will make us clear whether the interest rate will fluctuate or will be rising or falling, but there is a probability attached with it. That is how the future spot rates will be more relevant compared to the only spot rates, because only spot rates make it clear that the rates are basically fluctuating, but future spot rates make it very clear whether it's a short term or a long term. Borrowing and lending can be done accordingly based on the expected level of inflation. So that is what comes the notation review based on all these concepts that we have developed. Like Rn stands for the spot rate for a loan negotiated today and repaid in the period n. That means this is basically the loan which is raised in the year 2022, but it will be repaid suppose in 2027 or 28. That is the Rn. Fn is the forward rate for a 1 period loan repaid in period n. That means we find out 1 period loan in the sense with a lag of 1 year, but it's repaid in the current year, but forward because of the rate which is projected in future. N minus t Fn is a forward rate of a t period loan repaid in the period n and borrowed in the period n minus t. That means it is borrowed in the previous year, but it is repaid in the current year, and that is how a forward rate comes in. And there is an expectation imposed in this entire expression just to show how the future rate of interest can be borrowed and contracted, and what is the expectation of the probability attached with it, because the levels of inflation will fluctuate and thereby the expected level will come up. So based on these notations, we can understand different levels of forward rate and spot rates, as well as the expectation determined model that comes in. So this boils down to a very important question on what are future spot rates. So basically we can say that a future spot rate will be the rate for a loan obtained in future but repaid in a later period. So it's not that the spot rate only, but it's a spot rate of the future period. Unlike the forward rates, future spot rates will not be fixed because it will be changing, and also the loan that will begin today will be circumstanced in the near future. So that is how the future spot rates come up, and thereby the expectations model will grow up. So all the expectation models based on the term structure of interest rate are based on the underlying presumption of future spot rate, forward rate, and the spot rates accordingly. Based on the earlier presumptions of interest rate, spot rate, future rate, and also the expectation model, now we go for two important theories which are governing the interest rate term structure. The first theory comes up as pure expectation hypothesis. So in this pure expectation hypothesis, we mean that the expected future spot rate of interest and the forward rate of interest will be equivalent at the date of the maturity, and this can be taken up with the help of the spot rates. Other words, the forward rates are also considered to be the unbiased predictors for making the expectations of the future spot rates, because these unbiased predictors are important for estimating the model accurately. So basically we can say that all our previous calculations tell us that if we believe in the pure expectation hypothesis, then we shall be able to make it clear about the evaluation of the rates, whether it's spot rate or a forward rate. So consider the given expectation of inflation over the next year, where the investors require 4% for a 1-year loan. That means it is basically considered of the previous year the loan is raised and it will be repaid in the current year, and the rate of interest as decided is 4%. Suppose the investors expect inflation for the next year to be higher. That means here the expected inflation is already incorporated in the model, which is the required to 6% for 1 year loan starting from 1 year from now. That means based on the higher level of future level of price or expected inflation, interest rate is expected to be around 6%. So based on this, we can go for a model which is consistent for the 2-year spot rate, which is defined as 1 plus R2 whole square, which takes care of 1 plus R1, because it is the initial interest rate when the loan is being decided to take up, by the expectation that is involved in 1 R2. 1 R2 means the loan is actually raised in the last year and it will be basically repaid after 2 years, and based on that the R2 is determined. So this R2 is basically the rate of interest which is being determined, and we can see it is 4.99%. So under pure expectation hypothesis, the expected rate would be 6%, and this percentage is close to that. So this basically gives us a very important issue regarding pure expectation hypothesis. So what is the underlying presumption of this kind of model which takes care of pure expectation hypothesis, which says that the expected future spot rate of interest will be equal to the forward rate, which can be calculated from today. That means any kind of loan which is raised today and will be repaid in the near future, how this expected and the future rate of interest can equilibrate together. This also boils down to the second important theory, which is called liquidity preference hypothesis. So by liquidity preference hypothesis, we mean a based on an empirical evidence, because based on the individual perceptions or individuals' preferences to invest, we say that investors have relatively short time horizons for bond investments. So whenever they want to invest in the bond, they want to get the return at the short span, and thereby the time horizon is less. So they are risk averse, so they will require a premium to invest in the longer term bonds. So this premium means they want to pay a premium, or they want to receive any dividend policy where they have to receive dividends, so that they can be some kind of protective shield against the risk of investment in these longer term bonds. So liquidity preference hypothesis states that longer term loans have a liquidity premium built into their interest rates. So whatever interest rates they are receiving, a kind of a premium is already designed so that any kind of interest rate is covered in it, and then it will calculate the forward rate, which will incorporate the liquidity premium and overstate the expected future 1 period spot rates. So basically the forward rates will be calculated based on the interest rate that is determined, and finally the expected future 1 period spot rate also will come in place. This is basically the ideology behind liquidity preference hypothesis that is being decided. So based on this, we can see the relation between inflation and the future spot rate. So suppose over the next year, investors require 4% for a 1-year loan. That is the loan which is raised in the last year and will be repaid in the future, and is expecting a 6% for 1-year loan from now, that is in the next year. So whenever we go for the liquidity preference hypothesis, by using the same formula, we come up with R2 as 5.11%. That means this is also very much considered to be near to the expected inflation, which is 6%. So under liquidity preference hypothesis, we observe that expectation is less than F2, which is basically 5.11, less than 6. So F2 overstates. For example, any kind of future rate of interest is overstating the current rate of inflation, and that is how things are coming in. So if we know the liquidity preference of the second year, then we can see the overestimation can be done, and thereby the overstatement can be easily done in case of liquidity preference theory. So we come to the discussion of what is the essence of liquidity preference hypothesis. So it states that the longer term loans are always preferable because they are built on a premium, which is an insurance or which is a protection built on the interest rates, and the calculation of the forward rate is done based on the liquidity premium, so that expected future and short term spot rates can be adjusted. So under liquidity preference hypothesis, we see that longer term loans are more better, more safe, because the forward rates can be calculated and it can overstate the 1 period spot rates. That is how the liquidity preference hypothesis is actually comes in. So when we want to interpret the term structure, we basically refer in the real life as a flat term structure, which means forward rates are considered to be targeted and they must be equal to today's spot rates, because spot rates are always dynamic, keep on changing. Forward rate can be targeted and these two can be equivalent. So we can say expectation for the same future spot rate as today if you believe in the pure expectation hypothesis. That means if we consider pure expectation, then fully the model can be explained by the expectation without any kind of discrepancy. But if we go for liquidity preference hypothesis, declining future spot rates will come up in the expectation model. So what we mean, that is expectations of similarly declining future spot rates and expectations for sharply declining spot rates are considered to be under the same periphery of pure expectation and liquidity preference hypothesis. So this boils down to interpretation of increasing forward rate also, which will be in a similar manner just like the pure expectation model. Like expectation for increasing future rate, that can also be done taking care of the increasing trend, or also the same thing can come up when the premium comes in, because once the premium is incorporated, then the slope becomes flatter or the intensity basically is on the fall. So we can now invite a question on how can we interpret the term structure of interest rate, that is a flat term structure means constant forward rates, a declining term structure means declining forward rates, and increasing means increasing forward rates. So all the three possibilities are taken care of. So now we can coming up to the summing up of this particular module, where we have inferred that the term structure and the interest rates shows the relation of interest rates at different levels of maturity loans, Two important theories can be proposed to explain that. One is the pure expectation hypothesis, where the spot rate and the forward rate are treated to be equal and where the expectation is fully adjusted. And another one is liquidity preference hypothesis, where longer term loan is being expected because of a premium built in it. Empirical evidence is very much consistent with it. Knowledge of the term structure and the theories are very much in tune with the future interest rate and the future bond prices, and this is very much important for the individuals as well as for the financial managers, whether they will opt for a long-term loan or a short-term loan, and that can be used for financing. And that is how the term structure of interest rate is dependent on.